Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Deren Flesher, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. All right, welcome to Wealth Beyond the White Coat. I'm your host, Deren Flesher, here with my co-host, Ross, and his partner, Matt Chancey. And we've got a special guest with us today. His name is Rob Woomer. Ross, why don't you introduce Rob?
Rob is the best looking guy on this podcast today, but he's also the CEO of Skyway Capital Markets, which is a managing broker dealer in the alternative investment space. So he's a wealth of knowledge, is going to share it all with us today.
There you go. Thanks, guys. And just to clarify that a little bit, we are more than just a managing broker dealer. We are a full service investment bank with M&A, capital markets, and the whole gamut of services we provide our clients. But our focus has been on the retail investors and financial advisors that serve them. And I guess we're going to talk a lot about that today as we go forward.
And right, so your business, you have two silos. You have the managing broker dealer, it's MBD as we call it. Then you have the M&A side as well, because we have clients you guys are helping on the M&A side. And then obviously we have clients who do things on your MBD side.
That's right. That's right. And both businesses are robust. It's about half our people and half of our revenues on either side of the shop.
And just to be clear, so that people understand what a managing broker dealer is, they don't actually work directly with retail clients. If it were a beverage maker, it would be the equivalent of Coca-Cola bottling company that does not sell Coca-Cola directly to customers. They are in the packaging and distribution business of getting that Coca-Cola to 7-Eleven, Circle K, and the other places for direct distribution to public. MBDs do not work directly with the public. They're a back-end distribution partner.
That's correct. And so think of us as a firm that people come to when they're looking to grow their business. And we work primarily with real estate and energy companies across the gamut, lots of different strategies we look at. But people say, hey, look, I've got this business idea, or I've been executing this business idea in, call it office buildings, right? I'm building office buildings in California. And I'm using like the worst example of something we wouldn't do. But I'm building office buildings in California, and you come to Skyway, hey, we need more capital. Real estate's a very capital intensive business. We need debt, we need equity. Can you guys help us? And so what we do is then say, okay, we like the strategy. I gave a bad example. That's not something we do in today's market, but we would have 5 years ago, and we may 5 years from now. And we talk through what is their strategy, who they are, what's their objective. Is it just money? Is it just to raise money for a project? Or are they looking to grow an investor services business where they're trying to enrich their investors? Obviously, everybody wants to make money along the way. What is that motivation? We go through a lot of different iterations, and then we decide if we want to, we're going to help them out. And to your point, Matt, we're not out raising capital directly from individuals. We partner with firms like yours. And we partner with 5 to 50 firms, depending on the size of the deal. We put together what's called a syndicate and get those firms interested in it. Usually, if it's gotten to that point, we filter through it. We spend a lot of time, and I know we're going to dig into all that in a little bit here, but we put that syndicate together, and then we help educate our financial partners, and to the extent needed, work with the investor, but we don't solicit investors directly.
Now, Rob, some of these people raising capital, these sponsors who need capital raised, they may be getting capital from other channels, maybe institutional, maybe family office, but they want to diversify their capital stack. And so they want to go to retail. That's what you see a lot, correct?
We do. So the prototypical story of a real estate company is you have a couple of people that come together and start raising what's called country club money, friends and family. You go out and find a deal, and usually they'll start with smaller deals. They'll raise money from people they know, and then they'll do that a number of times. I worked with a company for a lot of years, and they did that to the tune of about $75 million through 14 or 15 different deals. But at some point you run out of friends and family. And so they start thinking about what's next. Some people go to the institutional route. There's lots of institutional interest, in particular in real estate. You've got to have certain characteristics about what that real estate looks like. But institutions, there's plenty of them, starting with pension funds, endowments, large scale kind of money, the money that's out there that's very actuarial driven. They love real estate, meaning I have a pension fund. I have an actuary telling me I'm going to need this much money for benefits over this period of time. Real estate is highly predictable in most cases, and they're able to put in a very large allocation to real estate. It's hard to go directly to those types of investors. Those are reserved for the larger asset managers. Think of a Blackstone or somebody like that, kind of household name. But those types of investors then invest in smaller institutions, and those institutions to do joint venture deals, maybe be a seed capital for a fund, do a number of different things. So institutions, one way to go. The most logical way, though, is if you've been raising money and working with friends and family, you've been working with, by definition, high net worth individuals. And the type of that person depends on who it is raising the money, who that real estate operator is. But the logical progression is not to go straight to the institutional world. The logical progression is to say, hey, how can I find more high net worth individuals? They get our business. We've been good to them. We like working with them. And so a lot of that's the genesis of how they come to us saying, hey, how can we get in front of more high net worth individuals? And that's through good partnerships with different financial advisory firms like yours.
And many times they will have their friends and family, and then they will end up with friends and family of that friends and family. The referrals and introductions as that grows, which is a Gen 1 wrapper of tranches of capital. But then many times you'll see the sponsors get so big with friends and family alone that they've built their own investor communications department because there's so many friends and family that they have to communicate with about the projects they're doing and the scale. And so then they wake up one day and they go, well, we already have an investor relations department. We've already packaged this up in a way that a friend of a friend would feel comfortable investing with us. So now why don't we package this up even a little bit more and take it out to people that we don't know, that aren't friends, that aren't introductions, because we already have an investor relations communication mechanism in place. And let's educate new people that we've never met or would have never met to bring in new capital.
That's right. And so they've got a head start. One thing that I think is important when you're looking at different deals, different sponsors, if they did start that way with friends and family and they're raising money for a new fund or a new project, is the friends and family are they still part of that new deal? There's a concept called skin in the game, right? You want the person you're investing with to have money at risk. So they've got real money side by side with you. And if you lose, they lose. If you win, they win. But an enhancement to that is not only do they have their own money, but there's these people that have been investing with them that are still investing with them. I had one client, when I asked, well, what kind of skin in the game do you have? He said, I've got my own money in here, but the most important thing is my grandmother's invested in this. And that was just really powerful because perhaps he could stand to lose a few $1 million, but he sure as heck wasn't going to do anything to risk his grandmother's $100,000.
Sure. Makes a great
And
point.
they use the term they use for that's a co-invest, right?
That's a co-investment. There's different ways to do that. You can have co-investment through what's called a general partner. The general partner is necessary. It's the person who controls decisions for the overall partnership. You have people that put money in the general partner and the general partner then invests. I think a different and maybe better execution, what we advise all of our clients, is for that co-investment to be at the limited partner level. And so your general partner makes decisions, can or cannot be well capitalized, but that money that's maybe not in the GP, put it in the limited partnership. And the reason is the decisions that the GP makes affect all limited partners equally. And if they are a limited partner, it's just one more level of alignment that you feel comfortable with, that they're making decisions that are going to be in the benefit of the limited partner. Deals, when we underwrite deals, we've never had a deal go bad. We feel very comfortable in sharing the deals. We talk to literally hundreds of people every year that are looking to raise capital. We may add 2 or 3 at most. So we feel really comfortable about the deals that we're bringing to market, but things happen, right? Most recent example, COVID. I was working with a hotel company. And it didn't matter how good of a company that was, how good every employee there was, and every decision they made was the right one, but it was COVID and hotels were closed. There's just nothing you can do. So the deals don't always go in the right way, but you want to make sure that when decisions are made, that they're being made in the best interest of the investors, the limited partners.
Let's talk about that hotel thing for a second, right? Because you've got good operators or sponsors and bad operators and sponsors. And then you have a stressful event happen around hotels when occupancy of a hotel drops off the face of the earth, right? Due to a pandemic, which is completely unforeseen. That wasn't written in the business plan by any stretch of the imagination when it came to you. So then the question is, how do you mitigate the risk in a deal like that to make sure that being in the exact wrong place at the exact right time isn't completely catastrophic? Because I know that we had some hotel investments at that time and they had to suspend distributions and couldn't make payments to us. Clearly there was nobody was staying in the hotels, but they were able to manage due to low levels of risk and goal alignment with investors and not lose assets and get catastrophically wiped out. And eventually that turned into an opportunity for a hotel group that was managed appropriately because other hotel operators were losing assets because they didn't manage to the right standard. And that became the ability to buy other assets that would be more valuable in the future because of their operational inability to execute. So right place. You could be in the wrong place at the wrong time, but if you're with the right people in the right structure, you can survive it and ultimately thrive later if you understand how to navigate capital markets.
I just wanted to take a minute to discuss financial independence. For many of us who own a practice, we spend several years growing it and we eventually plateau in both productivity and profitability. At that point, we've got several options in front of us. We can either continue to physically expand the practice, whether it's an expansion or a new building. We can acquire another practice. We can acquire new skill sets or extend our hours, or we can simply enjoy the plateau and the fruits of our labors and the profitability for years to come. If you do that, however, the profit year over year is roughly the same, and when you go to sell it in 10, 20, 30 years, it's worth the same thing as it is at the point where you got there. So for me, the decision was easy. The time value of money meant that if I sold it now for the same amount I could sell it in a couple decades, I could put that money to work for me and pursue other passions in life. Whether it's simply working less, doing more of what you love when you are working, taking more vacations, or monetizing that hobby, there is freedom in cashing in your chips early, taking that money off the table, letting it grow and compound over the course of your career, and focusing more on what you love to do. If this sounds like something of interest to you, I'd love to introduce you to the guy who made that possible for me. His name is JW. He's a dental practice broker, and he did several things that facilitated this for me. He found the right partner to honor the mission, vision, and values of my practice so that it could carry on the same way it has for the last near decade. He maximized the valuation of my practice and really went to bat for me to make sure we got the best deal possible, and he optimized the terms of the deal that aligned with what I was trying to achieve on my path to exit. Now, because we have a positive working relationship, anybody that I introduce to him, he's willing to do a free valuation to let you know where you stand so that you can make the best decision for yourself moving forward. If you think you might be interested in selling in the near future and you want to take advantage of this free valuation to see if the numbers make sense for you, simply email me at Deren@legacypointgroup.com. That's DEREN @legacypointgroup.com, and I'll be happy to introduce you personally to my friend JW. Now back to the show.
Yeah, so exactly right. So when you're going into a deal, I think it's not unfair to ask questions about anything that you invest in. What happens if COVID repeats itself? Because it's the worst case scenario for hotels specifically, but just in general for a lot of businesses in real estate. So that's the worst case scenario. What's your plan? No one's going to actually have a plan for COVID again, but they should be thinking, okay, this happened back then. How do we avoid something if it was that bad? And knowing that you can't avoid everything. And so it starts with the underwriting, and underwriting meaning looking at the real estate you're investing in. what do you think realistically are our projections for income and expenses? What do you think realistically are our returns? But then importantly, how are we capitalizing this particular transaction? So in every real estate transaction, or most, you have some components that's equity. That's usually where we play and where your investors play. And there's some components that's debt. No different than your home, right? You buy a home, you put a deposit down, you borrow, same thing. And it's prudent to use debt, but it's not prudent to be over leveraged, to have an 80% loan to value or a 90% loan to value. There are people that do that, and there's times in the cycle where that might make some sense. But what happens is then if things go down, and the values go down, if cash flows go down, you can't service that debt. You are in risk of foreclosure. During COVID, banks really didn't want to foreclose on hotels because they would have to foreclose on all hotels because there were zero hotels producing cash flow in May, June, July, August, and beyond of 2020. They just said, okay, we'll work with you, we'll get through it. But it did wipe out a lot of value there. So you've got to have conservative leverage. Again, going back to alignment, having people with skin in the game and making decisions to protect principal. So going into the deal, they were looking to make as much money as possible, underwriting some really fantastic 15 to 25% annualized returns. They were hitting that, they were delivering that. That was a very base case underwriting. When COVID hit, you had to pivot immediately. Okay, let's protect principal. Let's not lose money. The one thing that's assumed, that's not talked about enough, is if I'm going to invest, I want assurance you're not going to lose my money. I want to make money, absolutely. And I'm investing in alternatives because I think I can get better risk-adjusted returns, but don't lose my money. And I know you guys know that, and I don't know if you explicitly discuss that with your clients, but it's something that's implied with every investment decision is don't lose my money. So that alignment in that case, they shifted very quickly to principal protection, made a lot of good decisions. It's a great example of where if they didn't have any money in it, no skin in the game, they could have just walked away. Here, give the keys to the bank, walk away, I've lost nothing. But having their money in, having friends and family, having that alignment, it was important, and they came through it. And they're never going to get the total return they expected, but it'll be a positive outcome for all the investors. So there's a lot of great examples out there where people have gotten themselves through no fault of their own, just wherever the market is, gotten themselves into a point where they have to make a decision. And most of the people that I've interacted with over my career, they make the right decision, but every now and then you get somebody that makes the wrong decision. It's set up that way from the beginning. There wasn't the alignment. They were making some bad decisions early, and it just compounds. There's lots of reasons that could happen, but you want, again, that alignment is wildly important.
It would be, I think too many people might look at or try to understand the underlying asset of how does this particular asset, whether it's multifamily, self-storage, industrial warehousing, hotels, whatever the asset is, right? And then there's the strategy on top of it. What's my strategy? Am I building new ones? Am I rehabbing older ones and repositioning other assets? Is it a cash flow strategy? Is it to make a lot of money and turn $1 into $2? Is it capital gain? So I think a lot of people look at the asset, the strategy, and the underlying economics of how that might play out. They don't even think to look at what's the structure of the way that I'm putting my money into this deal, and am I goal aligned with the people that I'm doing it with, and how much of their own money do they have in the deal, just in case their asset class and strategy and everything might be wrong. Can I protect myself from a structural standpoint when I participate in the deal? I don't even think the average investor is thinking that.
Yeah, and they're not thinking of that because they don't have necessarily the knowledge base, right? That's where you guys come in. And they don't also have necessarily the opportunity to meet the people. And I spend a lot of time with the people. Strategy is important, right? So I jokingly said I wouldn't touch an office in California. That's not a joke. I actually wouldn't. There's a lot of reasons not to consider that deal. But if you start with strategy and say, okay, broadly, I'm bullish on housing and I'm bullish on energy. Okay. And there's some other asset classes that I would do. But if I start there, then within those sectors, there's an awful lot of companies out there having different variations of strategy, and most of them have the wind in their sails for a lot of reasons, same reasons I'm bullish. But then bring that strategy, look at it. Okay, it's going to work. We're going to dig in. We're going to see what your assumptions are. We're going to see what your capitalization looks like. We're going to try to figure out if we really think this is a good deal. But it's not a good deal, if I don't feel good about the people that are executing it, the guys running it. You guys, we Skyway, we make sure that you have an opportunity to meet all of these principles. You get comfortable with it, and again, whether your clients are able to meet them or not, and we do events where they can, but if they can't, there's a trust level that you have with us, but you trust but verify and get that trust yourself. So people, very important. Strategy, obvious, that seems obvious, but spend time thinking about the people, and then dig into the structure, because there are structures out there that are just inherently flawed. It's not always obvious. And a lot of times it's because not necessarily the sponsor of the fund is trying to screw people over or anything like that. It's just a lot of times they get bad advice from consultants or lawyers or whatever.
You can have a quantitative analysis deal on the underwriting to make sure the numbers kind of pencil, but you have a qualitative analysis of the people and the human capital in it to make sure. There's an axiom in the space, right? You bet on jockeys, not on horses. The horse is the deal, the jockey are the people riding it, and you want an expert there. And many of the times that people would say that is, if a deal goes good, nobody cares, right? It doesn't matter. But if a deal goes bad, a bad operator or a bad jockey might just be like, hey, I'm walking away, I'm throwing it back. But a good operator and somebody that's got the right values and goal alignment will do everything they can to work out the worst deal under the worst circumstances. That's why I've always heard that you bet on people. If we're looking and we're betting on people, obviously we talk to people all day, every day. And some people we instantly can, they're charismatic and we hit it off with. That's why Ross is likable, because he's just a likable human overall. But not everybody's likable, right? But that doesn't mean that somebody, just because they're likable or not likable, is somebody that you would want to be in business with in a partnership as a GP relationship. We talk a little bit about how we look at those people to trust, but verify who they are, what they've done in the past, and like criminal and financial background checks on people, conflicts of interest checks, verifying that if they say they own some type of technology and patents and on that we know that's all true and they're telling the truth. Their academic education. If you say you went somewhere and you studied a thing, it's great to hear them say it. What does that process look like for digging into the humans after they tell the story? And you're like, hey, I get your asset class, I get your strategy, I think we can put together a deal. But let me ask you a question. Are you people we should even be putting together a deal with? Tell me why you're worth it, and how do we verify that type stuff?
Hey, I just want to interrupt real quick and say thanks for listening to the podcast. If you didn't know, we have an associated Facebook group also called Wealth Beyond the White Coat. Over there, you can ask your questions, get feedback from group members, and have a close community of medical professionals who are likely interested in the same things as you. Whether it's alternative investing, tax mitigation, ways to keep more of your money, or even protect your assets, we're going to discuss those things in the group. Additionally, we have a private investors club called Legacy Point. As a member, you'll get exclusive discounts to preferred vendors, and you'll get access to private investments that you'll find nowhere else. Whether it's hotels, apartments, oil and gas, equipment rental, you name it, we'll be discussing those details and offering those investments to members only inside Legacy Point Group. If you want to learn more about that, please contact me or simply email info, I-N-F-O, at legacypointgroup.com or go to the website legacypointgroup.com. And Wealth Beyond the White Coat podcast listeners get an exclusive discount if you use the code WealthBeyond. That's all caps, all together, WealthBeyond at checkout. I'd love to have you in the group, and I'd love to see you making more passive income as you move towards financial freedom, whether it's freedom to retire early, spend more time with your family, go on more vacations, or just do more of what you love while you're in the operatory. I'd love to see you doing that as part of Legacy Point. So here's to improving your financial health.
Yep. Hey, absolutely. And we spend a lot of time with that. We have I think it's a 56-point due diligence checklist that we do before we even start talking to anybody outside of Skyway on whether or not this is something that we should bring to the market. Certainly background checks are a big part of that. And that applies to all decision makers. It applies to the material capital, even if they're not involved in day-to-day business. If there's a large financial backer somewhere in there, we figure out who that is and why they're in and what their track record is and what have you. But there's also in our world, you guys are familiar with, There's also third-party due diligence firms. We do our due diligence and we do the background check. We find out who the people are. We find out what their track record is. We look at the current opportunity. If there are already hard assets that will be in the fund, we go look at those assets. We talk to the property managers. We make sure we understand everything that's going on, everything they're telling us, and we go through a whole robust due diligence process. And that just gets us to the point where we're ready for other people. Well, the first people that we're talking to are a third party due diligence firm. And there's 5 or 6 of them out there that do that. That's all they do. They're typically lawyers and they're looking at all of the legal documents. They're doing the same thing, background checks. They're looking at financials. They're understanding track record. They're understanding any assets that are currently in the fund. All that same stuff that we've already done. They do it a little bit without opinion. We are in our diligence process, we're forming an opinion. Our opinion that we want to come to, if we can, is this something that I want to invest in? And by the way, I invest in all of our deals personally. But do I want to invest in? Do I want to bring this to Matt and Ross and have them look at it? And do I want them to use their relationships that were their clients to then present this to them as an opportunity? So I'm thinking of all that along the way. The third party firm, really just a cold objective. They're not coming with an opinion. Is this a good deal or a bad deal? What they are there any gotchas in this deal? And they really go in with a fine tooth comb and they're like, okay, is there something in the structure that's not investor favorable? Is there something in the track record that's sketchy? Is there something in the investment strategy that has been proven not to work? There's just a lot of different things they look at very coldly, and it's a great add-on to all the diligence that we've done. And that happens before even you guys know that we're working on a deal or have found something that we think is good. And then beyond that, there's other layers of diligence. And I don't know if you want to go into that level of detail, but there's at least 2 or 3 other people that look at this stuff before you're even taking it and showing it to one of your clients.
We could talk a little bit about that because I would like to look, because one of the other things is being a guy that's on the front line of this, like doing this all the time. I know who the relationships are, like yourself in the managing broker dealer space, that are looking for good products, good people, that you can create good products, that you can structure it in a way that ultimately an investor that this is unknown to would want to ultimately invest in it when they saw the way it was packaged up in a best in class way. But then the colder, more callous third party firms that would look at something and try to poke holes in it, or just another set of eyeballs, right? Hey, maybe you guys got rose colored glasses because you like these people so much. And when you were trying to put together the deals, are you really sure you're seeing it the way it looks? So then, like, some of the things that I've done is I'll go look at a deal, and one of the ways you look at it from an investor protection standpoint is, what is this deal supposed to do from an economic standpoint? Is it supposed to be a debt deal and have an 8% distribution or something on it? I will say, wait a minute, do I have any other private credit offerings that I can get an 8% distribution or a 10% distribution or a 12% distribution or whatever it is, right? And then there's the duration. Is it a 2-year, 3-year, 4-year? How long are we holding it? And I'll say, against its peer group, I have 10 other things that do the exact same thing from a outcome standpoint. So then I'm like, do I need another thing to solve that problem to further diversify? So maybe I do need another thing to do that to further diversify. Do I trust and understand this thing that financially creates the exact same outcome as other tools that I already have? If I like it and I want to add it as a diversification tool, great. But if I just don't understand it, and I know when I try to explain to a client what they're doing, how they're monetizing, and how they're turning $1 into $2 or an income stream compared to the other ones, it's a harder story to tell because of the complexity of the asset or where this knowledge base came from or something. Like, I have shut deals down before, just like I don't want to educate anybody on that. It's just way too complicated of a story, and they're never going to understand it. There's going to be way too many additional questions. It's just, there's an easier way to get that same financial outcome. Like, when you guys are looking at deals, that's one of the things that I find is a way for me to easily exclude deals if I don't want to make somebody's life overly financially complex. How much of that thought of, will the investor connect with this? Will they understand it? Or is this just over their head for the most part? And we're going to have to tell them it's a good thing and they're going to have to trust us.
All right, that'll do it for part 1 of our talk with Rob Woomer of Skyway. We will pick up next time talking more about due diligence and underwriting. So be sure to tune in next week for part 2. Thanks for listening in to Wealth Beyond the White Coat. Your time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.